This is the current federal tax developments for the week of January the 26th, 2026. I'm Ed Zollers, CPA from here in Phoenix, Arizona, and we have a whole slate of court cases and administrative guidance to cover this week. As always, we'll be diving into statutory construction and practical implications of these developments for your tax practice. We have rulings from district courts, the tax court, the Court of Federal Claims, and new guidance from the IRS regarding the One Big Beautiful Bill Act. So here's our agenda for today. Shall we look at this? We have 5 specific developments we're going to discuss, ranging from procedural litigation battles to new statutory deductions. The first topic will be on ERC litigation. We're going to look at the case of Plastic Film LLC versus United States. This is a case for those of you handling employee retention credit refund suits. The district court provided a taxpayer favorable ruling on pleading standards, specifically whether you have to cite a specific government order in your initial complaint, while shutting down entirely challenges based on Administrative Procedures Act to IRS Notice 2021-20. The second topic will deal with innocent spouse relief, which is a tax court case of Zaheen versus Commissioner. The case involves Section 6015F equitable relief. It is a stark example of how substantiated spousal abuse can neutralize the reason to know standard and attribution of income rules, even when the income technically originated from the requesting spouse's own retirement account. The third topic this week is a financial disability case. This is the Goldman versus United States case from the Court of Federal Claims. This case is a warning regarding the attempt to use Section 6511H to extend the statute for financial disability. We're going to see how the existence of an authorized representative, like an accountant holding a power of attorney, can completely negate a client's claim of financial disability regardless of their medical condition. The fourth topic, we're going to take a look at a criminal tax laws case, which I know we don't do a lot of criminal stuff, but this one is a little interesting, and yeah, it's kind of a light guidance week as well. So we're going to take a look at United States versus Eckert. For anyone dealing with forensic accounting or criminal tax, this case distinguishes the tax laws under sentencing guidelines purposes from statutory restitution. The court held that a plea agreement that capped the loss for prison time does not prevent the government from seeking a much higher restitution amount. And finally, in the last, we're going to look at the qualified overtime under the One Big Beautiful Bill Act. This is the IRS has issued Fact Sheet 2020-601 to guide us through the qualified overtime compensation deduction for 2025 transition year, including specific rules for federal employees and, importantly for everybody, some penalty relief for reliance on the FAQ itself. Our first topic this week, let's go talk about the pleading standards and the Administrative Procedures Act challenges in an ERC case. This is Plastic Film LLC versus United States. Civil case number 5:25CV30 DCB LGI. This case comes from the Southern District of Mississippi, U.S. District Court, and the decision came down on January the 20th. So, we begin with this very recent decision from the Southern District of Mississippi. Right? This case is significant for anybody handling employee retention credit refund litigation or dealing with clients' interests in challenging the validity of IRS guidance under the Administrative Procedures Act. We've seen a lot of cases go down that road. The plaintiff in this case had filed a refund suit regarding payroll taxes in quarters 20 and 21. They had previously filed Form 941Xs claiming the employee retention credit based on suspension of operations tests due to the COVID-19 governmental orders. Now, the taxpayer asserted 4 counts in their complaint. Count 1 was the standard refund suit under Section 7422A. However, they got more aggressive in the counts 2 through 4. They alleged that IRS Notice 2021-20 violated the Administrative Procedures Act. Specifically, they argued the notice failed the required notice and comment requirements and was arbitrary and capricious. Now, the government moved to dismiss the case under Federal Rules Procedures 12B, lack of jurisdiction, and under 12B6, failure to state a claim. So, the government's argument, and this is the key practice area, The Department of Justice argued that the taxpayer's complaint was insufficient because it failed to identify at least one governmental order on which it relied to prove suspension of business operations. Essentially, they tried to impose a heightened pleading standard requiring specific evidence to be in the pleading. Now, the district court rejected that entirely. The judge noted that under basically the Internal Revenue Code section 7422A, the statutory prerequisites are simply filing a valid administrative claim and waiting the required 6 months. The court explicitly stated there was no binding precedent requiring a taxpayer to cite specific orders at the pleading stage. The judge recognized the sheer volume of state and local orders during the pandemic. Whether a specific order substantiates eligibility is a fact-intensive issue for discovery or summary judgment, and not by itself a reason to dismiss the complaint at the starting gate. Now, the judge is not saying they're never going to have to come up with an order that meets the criteria. That's still something they have to prove. But at pleading, they just had to say that standards impose that. We're going to assume they can prove that, right? That's all they've got to do to clear the standard. The court said we're not going to require them to essentially lay out the entire case, right? That's what discovery does. That's what that part of it does. And the actual trial will then look at that allegation, or even a motion for summary judgment, once we take a look at what's out on the table. So these allegations were deemed sufficient to plausibly state a claim, meaning that the refund suit for what ended up being the only unpaid quarter goes forward. That wasn't thrown out. So that's good news for the taxpayer, right? They can go forward with the one unpaid claim. After this, we get to something that's really kind of not really, it makes no difference to either side. After the complaint was filed, the plaintiff conceded they had actually received the refund checks for quarters 2, 4 of 2020 and quarter 2 of 2021. Now, in this case, the court applied standard Article 3 principles. Federal courts only have jurisdiction over live controversies. Since the taxpayer now had the money for those quarters, there wasn't any injury left to, for the court to address. So we're just going to get rid of those. They're moot, right? The claims for these paid quarters were dismissed, therefore, as moot. This left only the claim for quarter 3 of 2020 in dispute. Basically, you watch IRS activity during the pendency of litigation, and the receipt of the refund extinguishes the cause of action for that specific period. Now, please remember, we had an earlier different case where the IRS had, after the suit for refund had been filed, the IRS turned around and disallowed, or basically allowed, the refund claim. But then, they couldn't, basically the taxpayer tried to force the court to get that paid based on the IRS concession. Remember, in that case, the problem there is that the call on what to do to settle the case has moved from the IRS to Department of Justice. Now, we don't know in this case particularly how the refunds came through, but obviously, they've got the money. DOJ is going to have trouble suing them for it and probably doesn't want to sue them for it. So we're just going to concede this one's done. That's different. You still got that problem, though. Once you file the refund suit, Department of Justice is still who ends up getting control of the case at that point. And that means that even if the IRS continues on and decides, we think you qualified, that's not by itself going to mean you automatically get the refund. Again, we've changed areas. So keep track of that, especially remember that previous case we discussed. These two can be reconciled. We actually don't have enough facts to know even if there is a case where the IRS paid it without Justice Department approval. But the Justice Department is effectively, at this point, by not raising that issue ever, has effectively just endorsed what the IRS has done, even if they didn't formally approve it. And we don't have that. We don't really know any about that right now. Next up was the administrative procedure case. In essence, what's going on there? The taxpayer tried, as has been tried many times here, to invalidate IRS Notice 2021-20, arguing it was an unlawful agency action. This has been discussed in various circles, whether those IRS notices are binding. Now, if you know, I've talked multiple times before that I don't believe they're binding, which also means I also don't believe the APA matters. I think it's irrelevant. The court dismissed for lack of standing. To have standing, a favorable court decision must be able to redress the industry. And the court concluded what I've been saying all along. Even without even if they vacated Notice 2120, the IRS could still deny the claims based on the CARES Act statute itself, arguing the same arguments they put forward in the notice. Vacating the notice would not force the IRS to cut a check. It doesn't do anything, right? Because the IRS could reach the exact same denial conclusion without the notice. The Administrative Procedures Act claim lacked redressability. In essence, you throw that out, it changes nothing. It is, for all practical purposes, the litigating position of the IRS. And they're allowed to have that. And while I admit it would be better for you if you don't meet that criteria, if the IRS had different criteria, the court can't really force them to have different criteria. They can just come to court and says, the law says this is how it works. And the notice is just saying this is how we believe the law works. There's no fix. Getting rid of Notice 2020 is, as I've always suggested, not really worth the bother, right? Unless, now, if you can persuade the IRS, let's say, via, the fact we've had a change in administrations, and you could persuade Treasury to issue a new notice, that's great. But that notice is also just as irrelevant of being struck down under APA. Right? Same basic issue. That's just telling you what they think the law is. Okay. Now, the court provided an alternative reason also for dismissing, and this also goes down to it. The Administrative Procedures Act waives sovereign immunity only when there is no other adequate remedy available. Please remember the first count of their complaint. Right? The court held that a standard tax refund suit under 7422, which they are doing in this case, is an adequate legal remedy. If you can sue for a refund, you generally can't use the Administrative Procedures Act to attack the guidance. And the merits, in the interest of completeness, now this is dicta because the judge didn't really, use this to decide the case. Notice 2021-20 is an interpretive rule. Interpretive rules are exempt from the notice and comment requirements. The court even cited the real issues going on with the pandemic as a valid reason for the IRS issues guidelines via an FAQ rather than a month-long rules-making process. If you had the IRS actually shut down all ERC processing and go through a months-long process before they issued any guidance, that would be totally contrary to what, in essence, Congress was trying to do with the relief they gave in the CARES Act and the related act followings. So the Administrative Procedures Act claims were dismissed with prejudice, but the refund suit for Q3 2020 proceeds to discovery. And frankly, this is exactly what I've been saying since day one. Litigate the refund suit, and we'd love to see some litigated with real decisions on the table, which we haven't seen yet. But I think attacking Notice 2021-20 under some way you could get it thrown out is like, and then where would we stand? They'd still argue the same thing, right? People are too focused on that, as if somehow magically getting rid of that would magically mean that everybody gets their money. That's not how it works, right? That simply is not how it works. We just go back to the law. Remember the law? Yeah, we go back to the law. And the law has requirements to get this refund. So, yeah, I've considered the attack on Notice 2021-20 to be basically a waste of time. And this case kind of tells us, that's kind of been a waste of time. The refund suit, count one of this thing, is really what mattered. And frankly, they got paid 3 out of the 4 quarters. And then we'll go litigate the fourth one unless basically the IRS and Justice Department decide to, settle the case and just pay it out, which they could do. We don't know what the issue is in the third quarter. That's getting in the way. So essentially, let's talk about this. So the claim filed the motion, survived the motion to dismiss. Remember, there's only really one claim in play at this point, which was for Q3 2020, right? They also said that claim could move forward because they weren't going to buy the IRS's theory that in your complaint you had to name a specific order, right? That's just the nature of it. Under federal law, what you have to do is you have to file a claim for refund. And if that's denied, which IRS did in this case, then within 6 months of that denial, or basically, if that's denied, and actually they didn't do that in this case, or if they don't act on it within 6 months, which is what this is how they got in court this time, then you can go to district court if you want. You can continue to wait for them to process it. And as we know that we're backed up, this employer decided to go to court. And, in the interim, while waiting to finally get the court to pick this up, in essence, most of the claims were just paid out. Now, we don't know how that's come out, how they came out, how quickly it came out. Is there really a hang up on the final remaining one, or is it just the last one the IRS is getting to? We don't know what the issue is there. But they also, basically, the court was pretty devastating in dealing with Administrative Procedures Act claims related to Notice 2021-20, which is frankly in line with every other result we've had on these attempts to argue against the APA to just get Notice 2021-20 out of the room. Because frankly, it doesn't change anything, right? This is kind of the problem, right? It just doesn't, there's no redressable. If I do what you tell me to and strike it down, that doesn't mean checks are issued. What you really want to do is be able to go out, you're not going to prevent the IRS from arguing these as a matter of law. And I don't believe the court may look at Notice 2021-20 and might consider it, its arguments, but it's just going to consider the arguments as legal arguments, right, about the law. They're not final regs. So, basically, in the first count of this, you're getting the full question of whether, these various parts of the notice, these interpretations the IRS have about how specific parts of the law work, we're going to figure out if the court agrees with that or not. Or more importantly, if they agree with whether or not they agree with it, where they agree that you have enough evidence to show that you're entitled to a refund under the terms of the law. As I said, I think that has been, to be totally blunt, I think that has been something that certain people who are in the ERC, refund mill industry, they would blame that all along and say it was wrong and illegal, etc. But even if it is, it doesn't matter. And that's what the court's pointing out. Even if Notice 21-20 could be absolutely, totally wrong, the court will agree with none of it. But that doesn't mean, it doesn't make any difference whether it's struck down now. The court's going to interpret the law when we go to trial if this goes to trial, for Q3 of 2020, and they're going to then interpret it then. So if you somehow believe that knocking down Notice 2021-20 would magically get you your refund check, the court notes you're delusional. That wasn't going to do it. Okay. Next up, a case of equitable relief and extreme spousal abuse. This is Sahin versus Commissioner, Tacit Miranda decision 2026-7, and the opinion came down on January 26th of this year. Okay, let's talk a little bit about this case. This is an unusual procedural dynamic. Dr. Zahim is the petitioner, a physician. The IRS actually conceded she was entitled to relief. However, because it's an innocent spouse case, her husband, Mr. Ishan, who is the intervener, stepped in to oppose relief. So the other spouse, because remember, if this is innocent spouse relief, Dr. Zahim ends up being off the hook entirely for the tax due. And the IRS is going to go against the other signing party in the joint return, which this is Mr. Hishan, her husband at the time, and all the balance is going to be paid by him. Or the IRS, that's where the IRS will go to collect. Now, the couple owned a medical practice. Despite Dr. Zahim, as you might guess with that title, Dr. Zahim, being the primary earner and sole title holder of the real estate, her husband exercised total financial domination, right? And the court record is pretty graphic, right? It established a pattern of severe abuse, including strangulation. That's kind of extreme. Sexual abuse and threats against the children. And if you read the case, you'll find that I'm being a little nice about how I'm describing some of these. It's bad, right? That context is vital because it colors every part of this analysis. And it's going to end up wiping out a lot of things that otherwise would have broke for Mr. Ishan, right? In essence, this is going to do it. The tax deficiency arose from a specific transaction, a $257,000 withdrawal from Dr. Shaheen's 401k plan in her medical practice that was moved to a trust, then used to pay down a business line of credit. This taxable distribution was omitted from their joint returns. Now, we're going to discover that even though that's clearly income from her asset, right, her account, right, and it went to pay down the business loan, and she's the only one that could conduct the business. She's the only licensed physician. Even with all of that and the theory that, she should have known, she has a duty to know, you can't be willfully ignorant, all that's going to fall apart because of his abuse that the court found. He had abused her, so therefore the court says, sorry, the abuse takes out all of these criteria we would otherwise worry about here. So under Revenue Procedure 2013-34, one of the 7 threshold conditions is that the liability must be attributable to the non-requesting spouse. That's the quickest way to get the relief. In this case, the income source was clearly Dr. Shaheen's 401k. Under normal rule, income follows the assets, so this was her item. If we strictly construe, that threshold condition, then she fails that test immediately, right? So the tax court applied an exception for, in this case, abuse and fraud. The court found that Mr. Ishan had full control of the finances, he forced the transaction, and he used deceptive tactics to hide the nature of the withdrawal from her. Because he wrongfully claimed the item and prevented her from participating in the decision, the income is attributable to him for these purposes. Yeah, flipped entirely. Absent his abuse, threats, and effectively preventing her from questioning any of his decisions on this area, he transformed that income from hers to his, which is not a good thing in an innocent spouse case. Just going to say it that realm, that's a bad thing. Now, we get to constructive knowledge, which is a key. Dr. Shaheen admitted that she signed the 2019 return without reviewing it. Normally, for a highly educated individual, like a physician, failure to review the return typically creates constructive knowledge or a failure in the duty of inquiry. You cannot be purposefully ignorant. You have a duty to review the return. However, this is another abuse exception. And this turns everything back against the husband. The court noted that knowledge can be negated if the non-requesting spouse's actions prevented the taxpayer from questioning the return. The judge explicitly stated the specific history of violence, strangulations, threats against her and the children meant that she could not question the return without risking the safety of herself or her children. So even if that client is highly educated and signs a return, substantiated fear of reprisal, for actually doing that, right, for reviewing the return and questioning the return, that can override the reason to know factor entirely. So yet again, the husband snatches defeat from the jaws of victory. Okay. Now, next up was economic hardship. Dr. Shaheen is a physician who has a relatively substantial amount of income coming in. She conceded she could pay her living expenses, even if she had to pay this liability. So she didn't qualify for streamlined determination. This factor was considered neutral. Next up, did she get a significant benefit? This one was a little bit tricky. The unreported income paid down a debt on a building she owned, right? Normally, increasing the equity in your own asset is a significant benefit. That weighs against relief. Did you get a benefit from the income? That wasn't reported. Because if you did, you benefited from it. And because of that, usually we end up conceding or believing that it's okay for you to be at least partially liable for, the tax due on it. But the court looked at the reality of the flow of funds. Mr. Ishan controlled the business accounts and only remitted to salary her. She was only given like an allowance, shall we say, to work with. There was no lavish lifestyle documented. right, lifestyle. And because the benefit didn't exceed normal support in the context of his financial control, the court treated the significant benefit factor as neutral rather than negative. This is big, for this case. So, what's the conclusion here? Tax Court Memorandum Decision 2026-7. Well, what basically, for mental and physical health, the husband actually conceded on brief that Dr. Shaheen suffered stress and depression from the relationship. This factor weighs in favor of relief. Then the court looks at the totality of circumstances, a step back to look at the big picture. It concluded to be inequitable to hold her liable when she was effectively powerless to ensure the return was accurate. He wanted full control of the return. He wanted her not to look at it. He didn't want her to question it. He gets to pay it. Bottom line. So Dr. Shaheen was granted full relief for the $120,000 deficiency and a $24,000 actually related penalty. Right? Now, this says when you're representing a client in an innocent spouse case, or you believe there's one there, substantiation of abuse is critical. She had the evidence, right? It can act as a trump card that negates a lot of rules because if there was no abuse documented in this case, everything points to Dr. Shaheen just needs to pay. She's liable, and because she really has the income, reality is she's going to be the one paying, right? Documentation here. Documentation is crucial. Documentation of essentially the abuse, the information, the evidence presented. That got rid of all those negatives and ended up flipping the case in her favor. Documentation is important. And as I've even told my own physician in tax, documentation, as much as you as a physician don't like paperwork, if you're going to actually do something tax-wise, you really got to get the documentation in place. It's a necessary evil, like things you tell me to do, right? For my health, you're going to insist. I don't care whether you like it or not. It's a necessary evil. Okay, understand that same difference here, right? So, basic summary here on the chart. If you're watching the video, right? So the problem was an unfair tax burden. It was $144,612 in tax and penalties in question, right? But because there was a total financial control by her spouse, right, and years of significant marital abuse, that broke the chain. She was no longer chained to that, right? Got it down. Equitable relief. The abuse negated her reason to know. Poor mental and physical health favored relief, right? And the full innocent spouse relief was granted to the doctor in this case. So it's an interesting case because everywhere except for the abuse, this thing just screams she's not going to get relief. Highly educated, right? Competent, right? Didn't look at the return. It came out of her account, right? It was used to pay down the debt on her building. It's textbook. She's going to lose this one. But the abuse was so bad and so well documented, the IRS conceded it, and the tax court had no trouble working down that path either. Okay, next up, a little different type of way of trying to get some relief. We're going to look at financial disability statute. Now, what the financial disability statute does is allows us to file claims for refund after the standard 3-year claim period is up because we were financially disabled for some time period, and that financial disability period tolls the statute of limitations. And we're going to see how, though, that can be a problem because financial disability is not only about whether the taxpayer is disabled, but if there was an authorized representative who could have acted for the taxpayer, then any period that authorization was out there and valid cannot be, basically the statute is not stayed during that period. And that's the key issue we have here in the Goldman case. Goldman v. United States, case number 1:24CV01920 from the Federal Court of Federal Claims, I should say. And decision came down January 23rd of 2026. Okay. This case addresses a common but difficult situation. A taxpayer filing a refund claim many years after the deadline, and they're going to say it was due to medical issues. Okay. In this case, Mr. Goldman, the person looking for the refund, sought a refund for the 2017 tax year. The tax was deemed paid in April 2018, right? He never filed a return, right? So it's deemed paid then. We got this done. He did not file his refund claim until October of 2023, a gap of over 5 years. He is due a refund. Nobody's disputing he's due a refund except the years of him. Well, we haven't really got to whether he's due it or not because obviously we haven't gone to court this one too. The IRS simply denied the claim under Section 6511B2. This is the look-back period rule, which restricts refunds to taxes paid within 3 years prior to filing, plus any extension period. Since the tax was paid in 2018, the claim filed in 2023, that claim is just barred by time basis under the standard statutory rule of 6511B2. So he needs to somehow stop the clock. To bridge this gap, he argued for tolling under 6511H, which is the financial disability provision. He claimed financial disability. He cited major depressive disorder occurring from November 2017 through February 2022 as the cause of his financial disability. So he would stop the clock, right, during that period. Now, there are two criteria here. And while most often we're focused on the medical definition of disability, this medically determined physical or medical impairment, the statute contains a critical exception in 6511H2. The judge in this case emphasized the taxpayer is not considered financially disabled during any period where another person is authorized to act on their behalf in financial matters. The implication is it does not matter how severe the medical condition is, if a valid power of attorney exists, or if an accountant is authorized to handle the financial affairs, the statute of limitations still runs. The existence of an agent authorized to act negates the disability for tolling purposes. And unfortunately, there was an accountant that was engaged during some of this period, right? So Revenue Procedure 9921 sets the substantiation rules, right? Two distinct statements. Number one, you must have a physician statement describing the disability. The taxpayer had that. That one is there, not being disputed. He was disabled, right? He suffered from the conditions he said he suffered, right? And a taxpayer's statement certifying that no person was authorized to act on their behalf. This is what he didn't provide. If a representative did exist, the revenue procedure requires the taxpayer to disclose the beginning and ending date of that person's authorization. Now, Mr. Goldman admitted his former accountant failed to file his tax return. That's bad phrasing, right? That implied an agency existed. Now, we don't know for sure his accountant actually had the authority under the law to sign the return. But, that was bad wording, shall we say. However, his pleadings failed to specify the precise duration of the professional relationship and the detailed nature of that relationship. My accountant failed. So they're saying that account relationship could serve to, rip away protection while it was in place. So the question becomes, and we're going to illustrate why dates mattered. His disability was claimed when disability claimed ended February 2022. The suit filed in October of 23. So the gap here is we have 1 year and 9 months where the clock was definitely running, before the suit was filed in October 2023. The 3-year look-back rule, if you subtract that 1 year and 9 months, right, the taxpayer only has a 1 year and 3 month period of allowable time left. The question becomes, the accountant's authority must have been terminated within approximately 15 months of the April 2018 payment. If the accountant was authorized to act, now again, there are two questions. Was the accountant basically, what was the nature of the engagement, and did the accountant have authority to act? Right? Because the exact termination date of the accountant was missing, the court was unable to determine that Mr. Goldman qualified for tolling. We have to look at it because remember, this serves as a timeout. It stops the clock. But if you've got an accountant, who is authorized to act, you can't call that timeout. The timeout's not there, right? And that's the problem. Hiring the accountant then gets the clock running again. Or if the account was already there when in fact we get to the beginning date of the statute running, the clock starts running that date until such time as the accountant was not authorized to act. Again, if that goes on long enough before his authorization was removed, his or her, don't know which it was him or her, it's one or the other. If the authorization was not removed beforehand, then he's too late, right? Now, the case wasn't dismissed because the real issue is we just don't know. The taxpayer issued a show cause order requiring the plaintiff to provide the exact date the professional relationship ended, right? And get that information. Now, the key lesson for us, especially if you pick up a client, a new client you discover hasn't filed, financial disability is strictly construed. And when assembling these claims, you can't just submit the doctor's notes. You have to take a look at the client's history of powers of attorney and authorized agents. Because if that existed, if there's anything back there where there was somebody who was authorized to act, that period will still count against them. Because even though the taxpayer didn't file, the other party could have. And they failed to do so. Now, whether or not that account was, authorized to file is really not something the court addresses at this point because they don't have any real evidence, right? So you want to make sure you've got the timeline with claps showing there was no representation during this period, there is medical disability over this period, and make sure you still, basically the clock got stopped enough that the claim's still there. Because again, financial disability. Because you want to file the claim for refund before the time frame goes up, but you also want to make darn sure that, we are getting it, it's not a dead case before we get started. That's going to be the issue. Because omitting those dates is a fatal problem for the refund suit. And that's probably the biggest issue there, right? And we have our nice little diagram again that outlines how this case works from the start of it to the claim disability period. And then, the refund claim was filed. We got to find that claim got filed before the 3-year clock had run after April 18th of 2018. And that means we need a timeout in that period, right, where the clock stopped. And the question becomes, do we have enough time? Do we have enough of a clock stopping, situation to allow the case to move forward? Like I said, there were two problems. One problem was with his filing. He failed to basically state that, there was no authorized representative or document when the representative was and wasn't authorized. And then, number two, you really got to go back now out there and say, the doctor's note by itself is not sufficient. You need both parts, and now we got to go prove the second part. So we have two different problems, right? Because the accountant's employment dates, and I would say implied whether or not the accountant was authorized to act during that period on his behalf, which means effectively sign the return, that kind of puts in the court's ultimatum. Now, this is also why it's dangerous to get a power of attorney and not restrict what you can do. If you're not planning to sign the return, in essence, then not having the right. And I remember years ago talking with Bill Raby, about how, limiting powers of attorney probably is a smart thing to do. Because if you had the ability to do something and you failed to do it, for instance, let's assume the accountant had the ability to file this return on behalf of the taxpayer, prepare, file, do the return. For whatever reason, the accountant didn't do that. Now there is a potential the lawsuit could go back against the accountant for saying, you cost me all this refund money because you, who had the authority to act on my behalf, myself, who has a medical disability, it's going to be a kind of a, in front of a jury, it's going to be somebody who gets sympathy because you had the right to act and you failed to do so. You hung me out to dry. Now, the facts of how you got terminated, the situation, etc., we may find that, in fact, the client ended up screwing it up on their own, but that's really the problem. So you might want to consider, when you look at a power of attorney, don't just blindly accept all authorities. I never want to accept the authority to sign off, a settlement agreement on behalf of my client. I always want the client to sign it. And I tell the client, you got to be able to sign this. You got to be available to sign it. If for some reason you won't be available to sign it, and there is some really good reason, explain to me why I would need to sign it, then we need to get an updated power of attorney in that returns that power to me. But I'm going to initially claim I don't have that power, right? Because I don't want to find that you go off and disappear. I get a question to extend a statute or not, and whatever I do, I'm kind of good at, in essence. I'm just in trouble if I do it. I'm in trouble if I don't do it. And this could be a similar situation, depending on what the real facts are behind this. How much authority did the accountant have? How much data they have? What was the issue that kept the accountant from acting? We have to kind of talk about all that stuff. Next up, a nice criminal case for something different. This is going to look at sentencing guidelines versus required statutory restitution. Now, this is only a tax case because it kind of did involve damages to the government that were part of the sentencing, as well as overall damages that came in. So it was a partial tax case with his reference. This is United States versus Eckert, case number 2:22-CR 002371 from the U.S. District Court for the Southern District of Ohio. Opinion came down on January 21st of 2026. Somehow, this is a Ponzi scheme involving tires. Never really told me how this worked, and I didn't go look for more details on it. But it does seem interesting to have Ponzi scheme on tires. But tires were what was involved here. But this case is a crucial reminder that if you are handling forensic accounting, right, or criminal tax defense, and forensic accounting, you might be brought in, even if you're not an attorney, I'm not an attorney, but you still might be brought in as an expert, for forensic accounting to figure out damages. And you need to understand differences between sentencing guideline and how much basically the loss was versus the loss that may be imposed, basically the amount they may have to pay based on the loss for restitution. And that's where the confusion occurred here, right? We tend to focus on the tax loss number because it drives the prison sentence for tax evasion. But we also have a sentence here or an issue here for restitution, right? Now, John Eckert was involved in the Ponzi scheme, tires, and if I get interested enough after tax season, I might go figure out what the heck he did with tires to do this, but it's with tires, right? And he was charged with wire fraud and tax evasion. He enters into a plea agreement, right, to limit his prison exposure. The plea agreement stipulated a loss of about $25 million for purposes of calculating the guidelines, right? This kept his offense level to 20 levels, which is important for how long you get to spend in Club Fed, right? That's going to be key. After the plea, the government handed the probation officer a loss chart that totaled over $61 million. Okay, Mr. Eckert's defense cried foul. They filed a motion for specific enforcement. They argued that by introducing a $61 million figure, the government was breaching the contract, which is what, for practical purposes, the plea agreement is interpreted as, to cap the loss at $25 million, right? They're saying, hey, sorry, you got to live with $25 million. That's what you agreed to. Now, in this case, the judge's opinion is a lesson in constructing the statute. He said there are two separate legal regimes at play here, right? The sentencing guidelines, basically, under Section 2B1.1 are punitive. They use the term loss as a proxy for culpability to determine how long you should sit in your cell, right? How long you're going to be assigned to federal prison. The Mandatory Victims Restitution Act, which is separate, is compensatory. Its purpose is to make the victims, those who invested money in the tire Ponzi scheme, whole. The court cited Sixth Circuit precedent, United States versus Agrawal, to establish that these calculations need not match. In fact, they can expressly contradict one another without violating the law. The plea agreement controlled the punitive calculation, how long he would sit in jail. But the statute controls compensating, the people who were basically harmed by his action. Now, This is where the dollars amounts can diverge, 25 million versus 61 million. Because Eckert pled to conspiracy, he is jointly and severally liable to all victims of the scheme. Now, for sentencing, you might argue successfully that he should only be culpable for his part of the scheme that he directly touched. But for restitution in a conspiracy, which he's pleading guilty to, right? The defendant is on the hook for the loss caused by the entire conspiracy. So it is not at all, just like you're allowed to say your damages for purposes of sentencing was you cost $25 million. So we're going to use that for this issue. What you had directly did this. But because you agreed you were part of the conspiracy, where other parties also were doing damage at the same time, everybody in the pool there, everybody who was in and part of the conspiracy is on the hook for the entire $61 million, right? Joint and several liability, right? Now, defense cited Paroline versus United States regarding proximate cause, but the court distinguished it. They said that wasn't a conspiracy. He did not, in that case, the Paroline case, the defendant did not plead guilty to a conspiracy. In a conspiracy, you pay for the whole ship, even if you only steered it for a few miles, is the term used. Right? We're going to have to do the whole thing, right? Now, how do we interpret this? Again, plea agreements are contracts, so the court looked at the plain language of the plea agreement, the contract, right? The $25 million cap was explicitly tied to the phrase for purposes of calculating the guidelines. The guidelines are the sentencing guidelines. In a separate section of the agreement, Eckert agreed to pay restitution and an amount to be determined at sentencing. Oops. Because the restitution clause had no numerical cap and the guideline clause was specific only to the prison calculation, the government didn't breach the agreement by seeking $61 million in restitution at sentencing. Now you're kind of going, maybe somebody didn't read the agreement quite as carefully as they should have. And I suspect that question will be raised, because it's kind of like, you sign, this one said specifically guidelines. This part specifically said any amount to be determined at sentencing. Who didn't read? Who didn't read everything? So that's a potential problem, right? In reading and interpreting it. Now, the court denied the motion, right? That they should be, that his restitution had to be capped $25 million. The government couldn't argue for $61 million. There's no categorical rule limiting restitution to the sentencing guideline laws. Eckert would be sentenced based on a $25 million loss, lower prison time, but will likely face a civil judgment for $61 million for full restitution, right? Assuming the government can show that was the total damage. He'll be joint and severally liable for total damages. Obviously, when negotiating a plea deal or stipulations on the tax laws, you got to be aware that capping the tax loss for the plea does not necessarily cap the restitution you'll have to pay, right? Especially in a conspiracy setting. The MVRA is mandatory and generally uncapped. So be careful there, right? Be careful in that area. Like I said, bottom line, they, obviously there was a lack of understanding on the defendant's side of what exactly the plea agreement was, or they're just trying to get creative. I suppose that could be it part two. But basically, it's just, this is what you signed. And, the fact that you signed it, you had full legal counsel, providing you advice on this, and you signed it, well, you're kind of stuck. Okay, so basically, the two losses. Remember, there are two different things going on here. The purpose of the $25 million is solely for punishment. That's where the cap came in, right? However, victim compensation is meant to make the victims whole. It's a civil action. And the two loss calculations do not need to match. And the court ruled based both on the fact that those two don't have to match and based on the fact that the plea agreement had nothing linking them. It's like, no, the government can go for the full $61 million for the compensation for victims. The victims are not going to be limited to the $25 million the government agreed to for the sentencing for him. They're simply going to, agree that that's fine for that. We can accept that with him going away for whatever time period is appropriate, given that he he basically had deemed to have crossed a $25 million loss of the $61 million. But for restitution purposes, we're not going to shut off any other assets he has from the victims to collect from as they're trying to collect the money. That's simply the way it goes. Well, next up, we're going to talk about qualified overtime and Fact Sheet 2020-601, which also discusses Notice 2020-562 and 2020-569. Both of those we had talked about previously were issued earlier. The fact sheet was issued on January 23rd of 2026. Now, we're going to conclude, therefore, with this implementation of the One Big Beautiful Bill Act provision. As you may know, the legislation added Section 225 to the code, which created a deduction for qualified overtime compensation. Now, the practical problem we've got, here's our real-world issue for this year. We've been discussing it on the New Jersey Society of CPAs Connect site. The issues come up. They very clearly come up, right? The statute is effective immediately, but IRS systems are not, and neither are our employer systems. The IRS has acknowledged that Forms W-2 and 1099 for 2025 tax year will not be updated and were not updated to separately report this specific type of overtime. There are ways you can voluntarily report it, and some places are doing that on the W-2, but employer does not have to report it. So to bridge this gap, the IRS issued Fact Sheet 2020-601 to supplement the two notices. One notice was directed at the employees, while the others were directed at the employers. And while the notices provide the technical administrative framework and have something we basically, because they're Internal Revenue Bulletin, we can rely upon, the fact sheet is crucial because it translates these rules into accessible FAQs. And as we're going to discuss, it provides some reliance for taxpayers during this transition year before mandatory separate reporting begins in 2026. So if the taxpayer, if there is a foot fault where they don't actually meet the notice requirements, but they basically reasonably tried to follow the fact sheet, while they'll still owe the tax, they won't be penalized. That's going to be the big thing. Now, the big issue, which we have to worry about here, is what if you've got the video running, you see there's a nice big thing there in bright yellow letters, gold letters, whatever you call them, right? This is careful. Qualified overtime is defined strictly by the Fair Labor Standards Act. It must be compensation required under Section 7 of the FLSA. There are a number of exceptions to FLSA. In fact, piece of trivia that came up this past week on the New Jersey site was uncovered a discussion where, if you go looking, basically FedEx delivery drivers or delivery drivers similar to FedEx, they're in a big enough van, right? And, in a big enough van they're driving, they're not covered by FLSA. There's an exemption for FLSA. Now, my understanding is there are a bunch from the Wall Street Journal article back last year. There are a bunch of transportation style employees that were covered by other rules. In any event, so therefore the FedEx drivers cannot get a deduction for qualified overtime, even though they're paid overtime, right? Under various state laws, under just the company policy, Federal Express, under a union contract, doesn't matter. If they would not be required to receive overtime under FLSA, they don't have qualified overtime. So we need to understand, what was the overtime required under Section 7 of the FLSA? Was it required? And how much would have been required versus how much was paid? Again, right? How much was paid if they're required to be covered is going to be at least what should have been paid. That's kind of how this works. But it might be more and you can't deduct the excess. Okay. So what this really means is if you have voluntary overtime paid to people where it's not required to be paid, or the overtime mandated by a union contract where it's paid at times it's not required to be paid, or in amounts beyond what's required to be paid, that's not otherwise required by the Fair Labor Standards Act, does not qualify for the deduction. And what you do get of the required FLSA overtime is only the half portion of time and a half. So as I say, taxpayer works 41 hours during the week. On that 1 hour they worked overtime, they are, let's say their standard rate is $50 an hour. They got $75 for that one. Their deductible overtime is $25, not $75, but they may think $75. I got paid $75 worth of overtime. No, you got paid regular rate of $50 for that hour and then $25 because you were working overtime. So that's a deduction. By the way, clients are going to be disappointed, I suspect, in many cases by these particular restrictions, but they're clearly in the law. The fact sheet provides a specific example where an employer pays double time. In that scenario, the taxpayer cannot deduct the full premium. They can only deduct the 1/2 portion as relied upon to comply with FLSA. So let's say that one, under a union contract, was required to be paid double time if they worked overtime. So now they paid $100 for that hour. Well, 100 of that is definitely in excess of the standard rate, but FLSA only required 50 of that 100 to be paid. So only the 50, around 50, let's say they got 50, get $100 an hour. They got 50 that is in excess of the rate, no question, right? My example. But only 25 of that is required under the Fair Labor Standards Act because their rate was 50. 150% of that is 75. The fact they were paid 100, nice, but, and I would point that out to people, well, you could just not take the extra, but I don't know why you wouldn't. Yeah, you're paying tax on it, but they're not going to tax you over $25 on $25. I'd take the money. I strongly suggest taking the money. But you're just going to get the 25 FLSA would have required you. The extra premium pay provided by a generous employer or by a union contract will not be deductible. We're going to go back and restate that week, figure out how much FLSA overtime would have been required in the absence of a union contract or any other law, or just employer's generosity, right? How much would FLSA required in a vacuum? And you only get the excess, but you only get the amount based on that. That's how this thing works. Okay. Now, as I say, the caps, remember, this is not an unlimited deduction. The cap is set at $12,500 for qualified overtime per return or $25,000 for a joint return. And there's a modified adjusted gross income, MAGI, phase out. It fades out if modified adjusted gross exceeds $150,000 for a single person or head of household filer, or $300,000 for joint filers, right? Remind clients that while 2025 relies on calculations of pay stub, the information returns will change to separate reporting next year. And, you got to realize that next year, assuming your employer gets it right, and there's liability for them if they don't, you're going to be under absolutely these rules. We have to do our best job under the guidance of the notices and under the guidance of the FAQ to try to determine what the employee's qualified overtime is for this year, but next year it will be on the W-2. There's no question. And remember, modified AGI is simply for most people, it's just going to be their AGI, but otherwise modification be, you have to add back foreign income exclusion, add back the territorial income exclusion, right? Those are the key things, or the foreign housing allowance. That's foreign housing exclusion, I should say. You add those back. Most of my taxpayers don't have any of those. Therefore, it's going to be their modified. It's going to be their adjusted growth. Their AGI will be their modified AGI. Okay. Now, there is some special guidance buried in here. They gave us something very useful if any of your clients are federal employees, which not in the notices, but it's specific instructions for federal employees, right? And they tell federal employees, most federal employees need to look at their standard Form 50, SF50, notification of personal action. Look at block 35 labeled FLSA category. If that box says E, that employee is exempt and no deductions allowed. And on exam, the federal employee sitting across from you, called the IRS agent, is going to have a pretty good idea of what this form is and is going to ask to look at it. So you want to know what's in that block. Is it E or is it N? If N, they're non-exempt and basically eligible. Now, while the Office of Personnel Management covers most employees, there are special rules for the United States Postal Service, Tennessee Valley Authority, Library of Congress, etc., that may require further investigation. You won't have, in essence, this is not how you will make determinations for them. So you have to do some additional work there. But for your average run-of-the-mill person, let's say works for the Department of Agriculture, you're just looking for their, SF50 and seeing if it says they're exempt or non-exempt, E or N in that block. Okay, so that'll make it pretty easy. Now, here's the reliance issue, which I think is really, really useful. Typically, FAQs are not binding authority, and this one isn't either. However, this fact sheet contains explicit statement regarding penalty relief. A taxpayer that relies on these FAQs in good faith will have a reasonable cause of defense against negligence and accuracy of penalties if that reliance results in underpayment. Now, be careful not to confuse this with the notices. That notice provides penalty relief for filers, the employers issuing the W-2. Fact sheet 2020-601 provides protection for the taxpayer, which is the individual client. Now, the important thing to know is, though, the IRS is not necessarily really good with telling us when they update FAQs. They're supposed to tell us when fact sheets are updated, but sometimes they're slow. I suggest for every client on which you have to do a calculation of basically overtime. You're not just, the employer did not provide the qualified overtime on the W-2 that you should be able to just rely upon. I want, you should be able to print out essentially the FAQ on the date that basically that the taxpayer, signed the return, or you prepared the return, and make sure that's the one we relied upon. Put that in the work papers. Okay? That's the one we relied upon as of that date. And therefore, if in fact, because the IRS could change the fact sheets at any time. And I do suggest it'd be a good idea to go look at that page every so often where the fact sheet is. They put the notice out yesterday, and the IRS has a whole page of, they have both their news releases, they have them archived on the website. Go into Google, search for IRS news releases. You'll get it current year by month. You'll find the news release that relates to this, or go for IRS fact sheets. They have fact sheets by year. Look for 2020-601. You'll find this one. And just, follow it. Note what it says in the current version on the website as of that date. Put that into your work papers, print it to PDF, put in the work papers. When your printout probably from your PDF is going to show the date. And you just say, as of this date, this is what it said, and we relied upon it. So basically, over time now, if you look at the FAQ, the fact sheet, it pretty much tells you the basic structure here. You have to determine your eligibility, understand what's qualified overtime compensation, the FLSA rules, determine if you're an eligible employee. You can't be exempt. You got to be one who be covered by it. And we have special ways of knowing if a federal employee is eligible, right? The N, we're looking for N in box 35, under the particular, form that we've got there, right? You also need to then remember the limits in place and how the deductions fade away. Please remember, married couples must file jointly. The fact I never said where the phase-outs begin for married filing separate was not an oversight. Married filing separates don't get this deduction. If you're married, you must file a joint return to get this deduction. If you're not married, then fine. You're not going to file a joint return with anybody. You're going to get the deduction. But if you're married, you got to do this. And then the third step is to calculate your deduction, remembering that we are looking for the FLSA, the amount required to be paid in overtime each week, because there's a weekly calculation, under the FLSA, and compare that to overtime actually paid. So, in each time, you're going to look at total overtime paid, and based on the weekly test, how much overtime should have been paid, right? Or would have been required FLSA only. And that FLSA only overtime, if it's less than the overtime, you calculated by, taking away the regular pay rate, and it should be either less than or equal to. Otherwise, the employer has a potential Department of Labor problem. As long as it's less than, or, as long as it's, less than or equal to, should be that number is going to be your number, right? If the FLSE somehow works out to be greater than, well, they never got the pay, so you go back to what is actually paid, but the employer's got a big problem. So hopefully it's not the other way. Otherwise, it's like, well, I got a really interesting thing for you. They're underpaying you overtime. And, you could go to Department of Labor with this. And, it's legal perfectly. And the law says you shouldn't be retaliated against for this. but talk to an employment lawyer, to make sure you understand that the employer is probably going to be upset, and being upset, if in essence, assume they might get creative at finding ways to take advantage of you. So you really probably need to get the employment counsel and double check they really are wrong. Right? Double check me, because I'm not an attorney. I'm just doing this rough calculation, but I'm coming up with what looks like you should have got more. Run this by an employment attorney if you're concerned about it all, and then decide if there's something you want to do going forward. And don't come back to me for it, because I'm not an attorney. I feel like, especially now, since I've mentioned before that our landlord is now the State Bar of Arizona, I got to keep saying I'm not an attorney, to make sure nobody ever tries to accuse me of practicing law. But I would say, we need to do this calculation, and, and if it is a big number and you're getting way off, it might not be a bad idea to have an employment attorney look at how you're handling it. Are you missing something obvious? Is it an exempt employee in some way, shape, or form? So you might run it by there. That's a whole new kind of, consulting category for employment attorneys. It's helping explain FLSA situations to people trying to just do a 1040. Hey, new business line. So, hey, look, I got all your employment attorneys. You can inform them and tell them you found them a new line of business. It'll be great for them. I'm sure they'll love you. I'm sure they don't have anything to do these days. Anyway, so this concludes our update for this week, January 26, 2026. We've covered significant ground today. We looked at the strict pleading standards for the employee retention credit, litigation to the new statutory deductions under the One Big Beautiful Bill Act, right? If you have any specific questions regarding these cases or guidance discussed today, you can reach me at the email address shown on the slide, edzollers@currentfultaxdevelopments.com. For anybody here who's viewing this that's members of the State Society of CPAs in Arizona, New Jersey, Idaho, Minnesota, Illinois, and Washington, I want to remind you that I do monitor the Connect discussion forums available through your society. Feel free to post your questions or comments there. And if I think I know what the answer is, I will, I may speak up on those platforms and tell you what I think. Otherwise, thank you for joining us today. And we invite you again to tune in the future for another week of current federal tax developments.